our guest today is somebody that you don't hear nowadays too often. I was telling him before the show, this is the first time that I'm speaking to in my journalism career. And it's a pleasure to have Ajit Dayal, founder of Quantum Advisors and sponsor of Quantum AMC, to talk about a variety of issues. Frankly, there is no mandate today that we'll talk about markets necessarily. So, yes, we could touch upon that a little bit, but the topics would be varied and surrounding investing and investments within India and things around that. Ajit, so good having you. It's been, I mean, yeah, actually, I can't even say it's been a while. It's the first time. So thank you so much for speaking to us at BloombergQuint.
Thank you for having me. And since I've not met you for 17 years, I can talk for 17 hours or 17 days to catch up on lost time.
Yeah, that's true. Well, actually, so let's start with uh, how you how you see the current environment, the debate. Can I start off with that, because
Mhm.
the raging debate is around whether the decade ahead could be a decade of value investing. I don't know how people can think of decades, but let's assume that for a moment that that's how people are thinking about it. Do you reckon that that could be a possibility, or that we are already into it? Why or why not?
Okay, so I'm going to go back a bit in history. I started Quantum in 1990, that's 31 years ago. And that time we were collecting databases and collecting data and wishing to manage money. And then the rules for FII investments actually came in July 1991 with the path-breaking budget under Prime Minister Narasimha Rao and Finance Minister Manmohan Singh. We quickly had a joint venture with Jardine Fleming, and I used to manage about $1.52 billion under the Jardine Fleming umbrella from 1992 till 1995. Jardine Fleming and most other investors are people what we call momentum or growth or whatever you want to call them. They react to quarterly numbers, monthly. Of course, in those days we did not have quarterly numbers in India. We had 6 monthly unaudited numbers, which was path breaking in those days. So things have obviously changed with more information. There was no internet, etc., etc. And after I left Jardine in 1995, I had the privilege and the honor to work with a gentleman called Tom Hansberger. Tom Hansberger was a co-founder of Templeton Galbraith Hansberger, which is now in India known as Franklin Templeton, around the world known as Franklin Templeton. So Templeton was an equity house, Franklin was a debt house. And when they acquired the group of Hansberger Templeton, it was basically a value shop. So the first time I exposed myself to value investing was in 1997, right? So basically 7 years after my partnership of creating Quantum and 2 years after breaking my JV with Jardine Fleming. And given what I had seen about investing from the 1980s, from my college days till 1997, I said, this is great because the value investing is a very disciplined process. And of course, we've all heard of Mr. Warren Buffett. He's one of the most famous proponents of the value style. And somehow or the other, it's very individual. That that sort of is a style that I appreciated and liked because it forced you to think long term, it forced you to have a discipline, and it forced you to try to understand cash flows of a company rather than volume growth and sales growth and revenue growth, but ultimately what is the cash flow, what is profitability. Now, value investing will work in times when there is fear and people are worried about how long a company can sustain, and they will pay more for those companies that have positive cash flow, that have good balance sheets, etc., etc. In a growth environment where people don't care about companies' profits, they don't care about cash flow because money is cheap, because financing rates are close to zero in many parts of Europe, they're negative. In that sort of an environment, it is the growth or momentum investing that will do well. So I push the question back to you that if you tell me in the next decade, people are going to become rational, there'll be an actual cost to capital, there'll be an actual price to money, then I will tell you value investing will work wonderfully. But if you tell me we're back to the days when the Fed is going to say we'll keep on cutting rates all the way to negative, and the ECB will give rates to negative, and each time there's an economic crisis or a pandemic crisis, everyone's going to open the tap and let money free flowing, then I can tell you value investing will fail. So it's a disciplined approach that requires a disciplined central banking system. If there's no disciplined central banking system, value investing is not going to work. So I've tossed the question back to you. You tell me what the next decade is going to look like, and I'll tell you whether value investing will work or not. It's literally that simple. Having said that, I believe that an individual investor who's trying to achieve a certain rate of return is trying to get to a financial target, a retirement, a wedding, education for children, buying a home. They are seeking nirvana. And as I've often said, nirvana can be attained through various religions and various gods. The God that I follow, the God that I like, is called the value style of investing. But in the quantum mutual fund complex, we've actually built multiple paths for you to reach nirvana. Now, as an individual investor, you don't really care whether Ajit Dayal is a value investor, someone's a growth investor. You just say, hey, I want to reach that target. And there'll be times when I know that value will do well, growth will not do well, or vice versa. Growth does well and value doesn't do well. So you want to have a basket of equity mutual funds, which basically follow different styles and gets to your nirvana. Or as people are increasingly talking about, and I totally disbelieve this, and I'd love to talk to you more about this, about buying an index. And the index will get you to nirvana as opposed to actively managed funds. So to me, an individual investor should not care about value or growth. What they should realize is that if the Indian economy continues to grow, and I hope that the growth revives in the next couple of years, then there will be economic profits to be had, and that will be reflected in share market prices. And therefore, I, as Mr. Retail Investor, 28 and a half years old, median age for young India, my allocation, any financial planner will tell me, if I walked into an office as an individual at the age of 28 or 29, a financial planner will say you need to have at least 40, 50, 60% in equity as an allocation of your savings. In a very similar way, Mr. Young India investor, whether you're 28 years old or 45 years old or 50 years old, you need to have a significant investment in equities and you will reach your nirvana irrespective of whether it's value or growth or momentum or small cap or mid cap.
Well, since we've hit that part, let me try and talk a bit about that. Then we can get to the other more complex subjects, if you will, for markets by and large. But um, there are two debates that come out that have come out in the last 3.5 years that I've started the mutual fund show at Bloomberg Quint. One of them is this whole debate about whether index investing, since you brought it up, will eventually be successful in India, and can the start of that be now? Now, if you hear, for example, the Zero founder, as they say, or he says that that is the way he would want to build his upcoming asset management business. And there are enough and more active managers, some for the very right reasons, say that there is still in India still a market wherein active non-index investing will beat passive index investing by a margin. Uh, what are your thoughts here?
So, as I indicated, when I worked with Hansberger, when we had a JV with them for 6, 7 years, I was actually living in Florida and I was learning how to manage money around the world under the tutelage of Tom Hansberger. And I had the privilege then of actually being a fund manager for the Vanguard group. So Vanguard outsourced one of their funds to Hansberger, and I was the lead manager of their $2.5 billion fund. It was called the Vanguard International Value Fund, and it was an actively managed fund, not an index fund. What I learned from Vanguard was wonderful things. Tom taught me how to manage money. Vanguard taught me how to treat investors. And what we have done and tried to do in Quantum is basically try to build a Vanguard in India in some sense. But of course, recognizing, as Vanguard does, that index investing is certainly key, but there's also place for active management. What is unknown to most people is prior to 2018 or so, about one third of all assets managed by Vanguard were actually actively managed assets, where they would look for managers like Hansberger who had special skill sets, and they would hire them to manage, in our case, an international value fund, in other case, US small cap, whatever it may be. So there is room for both. even Vanguard acknowledges that. We launched our value fund in India. So we have a PMS license at the parent company level, Quantum Advisor, the sponsor. We manage about 2.6, $2.7 billion in a value style of management for large international pensions, sovereign funds into India. And we took the same product, the same portfolio, and we put that onto the Quantum AMC platform in March 2006. And that's a Quantum Long-Term Equity Value Fund, which currently has about 150 million or something under AUM in that one product. So what we learned was the same product goes to a large group and the same product goes to the retail investor in India. And in 2008-9, we launched a Nifty ETF in India in the quantum umbrella, saying that one day we know active management will fail, and we already have the ETF, which we can then showcase with a track record to our investors. So we've had an ETF, an index fund, if you want to call it that, in India for the last 12 years or so. But we have not showcased that. In 2010, I communicated with now the late John Bogle, who's the founder of Vanguard. I sent him data on how the indices are compiled in India. And his response, his email response to me, is a classic to be framed on the wall of those who believe in index investing. His response was that, Ajit, if what you are telling me is correct, much as I love index investing, I would not invest in the index indices in India. The way the indices in India are created are flawed. And you can use one very simple chart, and I'm happy to provide it to you. Just look at the Dow Jones, look at the S&P, look at the BSE 30, the NSE 50, etc., and also the MSCI India Index, and just see how many stocks are in that index going back 15 years, and see how many times the stocks change. So the turnover of the India indices is like 5x that of the international indices. An index is not meant to be changing and churning every day and every quarter. But the way the indices are constructed in India are actually faulty relative to how they're constructed in the developed world, which is why John Bogle, the founder of Vanguard, the guru of index funds, wrote to me and framed it on my wall, I guess, one day, saying, you know what, I would not buy an index fund in India. There is something fundamentally flawed in an index fund, the way it's constructed in some sense, which is that if I am an index provider, so take the case of Satyam. Satyam went bust in Jan 2009. The stock fell by 72%. If I had an index fund, I would have owned Satyam at that point in time. When the stock price collapsed, my portfolio takes a real hit, and I have lost money by being in Satyam. Well, you know what the index guys do? They just take it out, and they put in Sun Pharma, and they put in something else, and they have to rebalance all the others. Because if Satyam's weight was, say, 0.8%, Sun Pharma may be 0.6 or 1.2, and they have to rebalance the other 29 to make it equal to 100. Imagine all the transaction cost that's going on every time you're changing a name. You're forcing someone who replicates the index to transact in the entire, rebalancing of the portfolio. There is STT, there's transaction cost, there's bid offer spreads, there's a cost of transaction. None of the indices that are built in India take into account the cost of transaction. An active manager, each time I buy and sell a share, I have a transaction cost, I have an STT, I have a bid offer spread. So the first thing that SEBI should do is actually have the index providers build out a proper transaction cost of the index that's there. Otherwise, you're kind of cheating in some sense. You're telling me that you incur all the cost of an AMC and the transaction cost, and the index guy gets to have no cost. So that doesn't go. So two things. One is the indices are wrongly constructed, and secondly, the way they are shown to the world to be mimicked is unfair to the extent that you do not have any transaction cost in them. So that's one thing. But take the more sort of fundamental long-term view. Indices worked well in developed markets, in my view. India is a developing market. There are new companies being born. There are new opportunities born. There's misinformation or misunderstanding of information, and where people can take advantage through active management. An index will only take a stock in after it's popular. You remember Unitech and other such stocks? They were unpopular. They
Anything.
became very popular. They got in the index and they got out. So how do you get all that upside before a stock makes it to an index, etc.? And how do you get out of a stock before the index guys realize, oops, we made a mistake by hanging on to Satyam, right? So I think it's too early to call the death of active management, far too early, but there will be a point in time. There will definitely be a point in time when you can say, you know what, I believe that the index fund is far more accurate way of getting into the Indian stock market and making money than buying a bunch of equity funds from Quantum or from other fund management groups. But it's too early for that, in my view.
Okay, point well taken. Let's talk about the other aspect, which these days has gained some, how do I say, official popularity, and that is ESG. Now, I saw you, uh, you were in some way connected with an ESG evaluation. If I'm not wrong, I was googling it and it came about. So forgive me for not knowing it to the T. But my larger question is, and you may want to develop on that a little. But my larger question is this: that world over, reports show how funds which will invest only in ESG compliant companies are gaining size and popularity. Funds which are probably having better returns are shown to have a very large ESG compliance or ESG element in their investing, but this is for the rest of the world. How do you think this whole uh, how do I say, mechanism will fit into India? Because there will be some companies which will be ESG compliant as as an aside, so to say, but a completely ESG focused company in India, and many such companies in India, is something that might still take some time, precisely because of the reason that maybe we are developing and therefore have to do a lot of other things as well. So, what are your thoughts on this whole topic?
So again, while with Jardine Fleming and the joint venture Jardine Fleming Quantum, I learned a lot of things. I also learned things that I would never want to be involved with. And that's why I left the JV actually and went back to being independent in 1996. So one of the first things we did after my departure from Jardine and restarting Quantum version 2.0 in 96 was we built something called an integrity screen. Now, we did not understand ESG at that point in time at all, but we did understand that there were issues with companies largely dealing with the way they treated minority shareholders or lack of transparency on promoter connected holdings, or in some cases, few instances, when you had pollution controls or lack of it. For example, South India Viscose and in Jardine Fleming, we actually helped them raise money, and literally 6 weeks after we raised money, there was a leakage in one of their factories in Tamil Nadu. And that factory, again, I think it may be scrubbed from the net, but that factory actually polluted, went downstream, and either injured or hospitalized or may have even killed some people down in downstream villages. And that was South India Viscose, a Shapoorji Palaji company way back when. And the reaction at that point in time from South India Viscose was, well, we really don't know what to do. It's a joint venture with the Tamil Nadu government, and it kind of just left it over there. No one really cleaned up the place. And I think in 2001, the Tamil Nadu government had to actually auction off the land and saying one of the conditions is whoever comes there to this old factory has to clean up the old factory. So there was some kind of, issues about pollution and all that stuff. Now, ESG was not known then. So we just looked at what we called integrity screen. So I go back again in history. I used to work for the Birla Group long time ago. And of course, in my early days of research, I would visit Jamshedpur and Hindalco's factory in Renukut, et cetera, et cetera. And you saw the wonderful communities that were built in those places because we took the Russian model, right? That you built a whole factory and you looked after the temple and the church and the mosque and the school and the hospital. I remember Jamshedpur, you could actually drink the water from the tap. And me, I'm from South Bombay, so I've got a very weak immunity system. I could actually drink the water and not die, right? That was a big thing for me to realize, which you can't do anywhere else in India. So you realize the power of community building of a company. So we built all this into our integrity screen to see how do managements look after their employees, their shareholders, the minorities, etc. And we've had
Sure.
that process since 96. Fast forward 2013, 12, 13, we started reading more and more about ESG in the world. And we took that integrity screen and we compiled it into an internal ESG scorecard for the companies we have. So we have a value portfolio where valuation metrics matter, price to earnings, price to cash flow, price to book value, with a minimum ESG score that the company has to have to qualify to be in the portfolio. We took that ESG database and made a new portfolio. And we launched that fund and the Quantum Mutual Fund platform in July 2019. That's the Quantum India ESG Fund, where we said, depending on the score, ESG score, that company finds a place in the portfolio, and its weight is a function of its score compared to the total score in the database that we have. So it ignores price to earnings. It ignores price to cash flow and price to book value, all the tradition metrics. It ignores earnings potential, ignores EPS growth rate, only looks at what you referred to, the goodness of the company. And with the
How's the
theory
fund
being,
doing?
it's doing extremely well. It's doing fantastically well. So, the quantum culture is when we launch a fund, we don't make a lot of bandbaji around it. We launch it and let it prove its time into a cycle. So July 2019, when it was launched, we said, okay, it'll take 3 years to go through an up and down market cycle. Well, COVID made that up and down cycle into literally 13, 14 months. And by September 2020, we'd finished the cycle. And the fund has done fantastically well. You all should look at it. I mean, of course, with all the disclaimers of risk and return and past performances, not big, but you should look at that. It's interesting. So we've already got that fund. And it is that fund which we are showcasing to our international clients saying, look, we are value managers and we have a minimum ESG score, or here is a fund, here's a portfolio which is built entirely on goodness. And it's our assessment of goodness. We're not using any external service provider. And the reason we're not using any external service provider, not that we wanted to build our own database, but we asked them a few years ago for sample reports of companies we know fail our ESG scores. So Reliance or an SR or a Vedanta, they do not make it to our ESG scores. They fail. We've not owned a Reliance, an SR or a Vedanta, et cetera, stock since 1996, been a long time. And we missed a lot of returns right in the process, but we don't own them. So again, there is no one definition, one correct definition of ESG. It's evolving, right? I mean, even if you look at an annual report today, every analyst gets the same data and they all have different views on a company's future. So in a very similar way, there's no one right number for ESG. And we're not saying in any way that our assessment of a Vedanta or SR or Reliance or a Tata or whoever is right or wrong. It's just what it is, the way we look at it. Beauty and ESG lie in the eye of the beholder in some sense. So anyway, we went out to the external world and we asked for sample reports, and the companies we did not like, they gave high glowing marks to. So we said, forget it, we'll just build our own database. And that's how we started building our own database. But I believe that, that's another product that investors should look at, because it's another style of investing. It's another path to nirvana. And you don't know which one's going to work. So you sprinkle your money among 3-4 different styles, including ESG. But I think ESG is here to stay. It's a major focus area for international investors. And one day it'll come into the Indian stock market too. It's not yet here in a big way, but it will come.
Yeah. So actually, I was going to ask you, I mean, your last line that it's not yet here in a big way, but it's going to come. Just one nuance, and maybe your conversations with global managers, etc., would give us a more informed opinion from you. There are some businesses which, by the very nature of the work that they are doing, probably don't comply with the E part of the ESG, right? I mean, most of the annual reports that I read right now, not most really, okay, but I qualify most of the good companies' annual reports that I read right now do comply with the S and the G part very, very well. They write enough and more material about that. But there are some businesses, by their very nature, are not necessarily compliant to what is internationally an E-compliant score. What happens in such a scenario? I mean, we hear power companies say that by 2030 or 2050, they'll be fully renewable. But until then, what happens? It's a good company. It's trying to do all the right things.
Yeah.
So what happens, and what will funds choose eventually, 1, 2, 3 years down the line?
Yeah. So, you've taken to a very, very big picture level, right? So we've got the Paris Climate Accord. We have discussions. Biden just hosted a conference where he called different leaders of the countries to talk about, the commitment to climate, etc., climate change, etc. And India has a huge role to play in that process. Now, India uses 65% of all our power that we consume. The Zoom call, your electricity, or my Zoom call, my electricity, are really on gas or coal or whatever. So there are things which are creating terrible carbon dioxide in the world, which the world doesn't want. Now, in theory, much as I may like an Infosys or a TCS or a Wipro or whatever, end of the day, where are they getting their power from? They're getting their power from dirty sources. So a big question, and there's no answer to this. How deep into the system do you go to see whether you are a dirty company or a clean company, right? I may have a wonderful garden, a wonderful golf course, a very nice thing in my internal factory, my internal campus, and I may be clean. But if the wire that's coming into my factory to give me all the power to power my machines, my research analysts, the computers, and all that stuff, if that's a dirty wire, then do you punish me? Or do you recognize that, look, this is India? And I know that India will continue to use coal, rightfully so, because we don't have the alternatives right now that are inexpensive. It'll take me 20, 30 years as a nation to move to cleaner sources of power, right? The Western world has the luxury that they've had 200 years of history of burning coal, and they've created massive wealth. In fact, I think about 90% of all the greenhouse gases emitted in the world have come from the industrialized nations, right? And only China, of course, the last 20 years, and India, the last 5 years, are contributing to the stock of greenhouse gases in the atmosphere. So, how much time do you give China and India, Indonesia, Cambodia, Vietnam, Africa to get their carbon emissions right for the basic thing like power? So again, it goes back to how deep you want to go. And the way we look at it, and again, there's no right answer, it's a more practical aspect. I cannot, I cannot force, I cannot sort of, convict Infosys. I cannot penalize Infosys or TCS or HCL or Wipro or whoever because of the source of power they use coming from the national grid. But I can see what they're doing internally, right? If they all have computers, then I want to know what are they doing when their laptops are thrown away? Are they being discarded in an environmentally friendly way? Those sort of questions I can
Got
ask
it.
and I should
Yeah.
get answers to. So I think you have to be very cognizant that we live in an economy, and not only us, Indonesia, Africa, many developing countries, where we have yet to provide many, many, many of our citizens a lot of basic rights or goods or freedoms or options in life, from electricity to schools to homes to everything. And how do you balance that? But at
Yeah.
the company level, we can certainly gauge internally. You tell me what you're doing not to add to the world's problems. That's the question we do ask. And if we don't get the right answers, we want to know what is the management doing about it. So to me, and when you look at our entire sort of process of my colleagues, governance is the key thing. The
Hmm.
intent of the management, their ability to listen, to absorb, and to find a solution. So I won't penalize you for doing something bad today, but I will penalize you if you don't plan to change it in the next 5 years. That's a more practical way to look at it.
I guess so. And I think on the G part, we probably have a bunch of companies, and not size dependent, but even
Mhm.
mid-size and small-size companies which are doing well. By the way, incidentally,
Yeah.
have you thought about the electric car problem or the electric car issue? I mean, you're driving power from coal. So is it actually contributing
Correct.
positively or negatively?
Correct, exactly. So there's been a lot of studies on this. Like if you break up the electric car, all the different components, where did they come from? How much carbon did they use to manufacture the car? So it goes on and on and on. Look,
Hmm.
there is no doubt that, if you want to be a critic and you want to find any fault, you'll find the fault in everything. I
Sure.
think the intent should be clear that we have to move in a particular direction, which is certainly environmentally friendly. And I think equally important, on the social part, on the equal opportunity of employment part, right? In the US, you've seen the Black Lives Matter movement. In India, we've had for decades the discussion of Dalits, of reservations. The court recently struck down Maharashtra's rule for having more options for Marathas, etc. So these are other social issues that, at the time the Mandal Commission kind of crept up and exploded within
Mm.
India, where you talk about reservations and equal employment opportunity, where caste, gender, and all don't play any role in the hiring process. So there's a lot of work to be done around the world,
Sure.
including in India.
Just one final question though, is maybe ESG being a vital or a necessary component may not be true currently in India. You reckon 5 years out, almost any large fund which is investing in an Indian company, which will, I mean, a number of companies will be much larger in size than they are right now and will need international funds. Do you reckon that will be a cornerstone of any company's activities, that it needs to be completely or majorly ESG compliant? Otherwise, funds might reject it, never mind the
Abs-
business prospects.
Absolutely. I mean,
Five
all,
years
all
or
companies
longer?
cannot. Well, I think it'll be actually 2 or 3 years. I
Two
don't
or
think
three
it's going to be
years.
5 years. I think it's going to be
Wow.
very soon. It's going to be very quick. And I'll tell you, we're not watching this closely, but in Europe, there already is legislation which is policing where European capital is being invested around the world. So if we are looking to access international capital, and as we grow as an economy, we have a savings deficit. I mean, i.e., our investment needs are much more than our domestic savings. So we need multinational money, we
Yeah.
need portfolio money, we need debt equity, we need all sorts of capital. Or much of this capital that we get from outside India, including Japan, Europe and Japan, and somewhat US, they all are looking very closely to see how is this capital from their home countries being invested around the world. So we'll have to be very quick in trying to recognize the importance of ESG and the power of ESG. If you use it right, if you have, and I don't mean in terms of dressing up and what they call greenwashing. So, we wrote an article in Quantum, you should look at it. It's called eyewash, hogwash, and greenwash,
Greenwash.
where ESG is EHG. So a lot of companies write things in the annual report. And if you just, scrape a little bit, it's an eyewash and a hogwash and a greenwash. You can fool us analysts and fund managers, but you're not going to be fooling regulators around the world who will be policing the home source of capital when it comes into India. And I should add
EHG.
also, should add one thing on that. SEBI is moving very quickly on this. I've had the privilege and the honor again of being a part of some discussions around this with SEBI and the regulators, and it's moving very quickly to understand and try to implement laws that are likely to come in Canada, Europe, etc., into the Indian framework. So I hope that company managements take it a lot more seriously now.
Yeah. Yeah, well, most certainly. And but I mean, to their credit, there are some managements which are doing this wonderfully well, and it's just a treat to hear them when they speak about it. Ajit, as not as an aside really, but something that I wanted to talk to you about when this issue first broke last week. I'm just moving tracks a little bit, but since we're talking about managing money, asset management, there have been a number of laws SEBI is brought out governing the AMC industry. And to an extent, I've heard in close quarters, in a private basis, many mutual fund CEOs tell me that the quantum of disclosures that they have to make is probably more than any of the industries. Last week, though, the announcement that came in from SEBI, and I'm going to play the devil's advocate out here, Ajit, because I have arguments on both sides. I want to hear your argument. I'm going to counter that.
Okay, sure.
Yeah, where are you on that? Do you agree? If you can comment on this, because you might consider yourself a related party, but still, do you agree that with this ruling of 20% of the money being parked in the fund units itself, or do you disagree with that? Why or why not?
You want the answer or you want the rationale? What do you want first?
No, you go. I'll try and counter you.
You're going to counter me? Okay, fine. All right. Let me go back a bit. I love talking a bit about history to get the roots. So 2006, Quantum launches its first value fund in India on the mutual fund platform as a mutual fund. And we were the first mutual fund house. We were the 51st AMC at that time, but the first AMC to only have a direct to investor sales channel. No distributors, no commissions paid to anyone. 2006, 15 years ago. The SEBI rules at that time encouraged fraud, encouraged misuse of distribution channels, encouraged what we call the asset gathering model. I've come out on TV and written articles that when I look at the license we got, it said asset management company. It did not say asset gathering company. And the SEBI rules at that time encouraged the opacity, the opaque system where fund houses, along with distributors, would sell and resell, and missell effectively, an investor from fund one to fund two to fund three, each time getting a massive upfront fee and all that stuff. And SEBI let it go. And in that vicious environment, we said, you know what, we will sacrifice our own AUM growth because we will not be part of a bad system. And if you look at the history of quantum, we have many, many, many firsts to our thing. We did things before the regulator made them into law, right? So that's our history. We are very clear, we're very focused on doing what is right, and it comes from my experience of managing money for Vanguard, as I explained. I learned how to treat investors by talking and working with Vanguard and meeting their management team over years, over 5 years. So we implemented all of that. So I want to lay the ground for what I'm saying very carefully. So we basically are very, very pro-investor. We're very fair as a company in our view. We don't have 200 funds. We have literally 10 funds. And we've got building Lego blocks. We tell investors you can asset allocate on our platform. You can buy the long-term value fund. You can buy the India ESG fund, 10 rupees, 10 rupees, and 80 rupees you can put into an equity fund of funds where we look at other fund houses, small cap, mid cap, large cap, whatever they are, and we buy their funds on investors' behalf. So we are the only fund house that tells you that. Come to us, give us 80 rupees, we'll give it to someone else to manage. They get the fees. We get a very, very small fee. So you come to us, we give you the whole solution. Gold, liquid fund, and you're done. Okay, so that's us. Having said all this, I think, so I recognize, and I know, and I've been fighting this for a long time when I was running Quantum AMC and Quantum Advisors, I know that there are bad habits in the mutual fund industry. When the Franklin Templeton debacle happened a year ago, I actually went on TV and I said SEBI should suspend their license if they believe something is wrong. And I think what's happened is that there is a significant regulatory overreach in this circular of last week. So the mutual fund industry is built by saying that you have to be fit and proper. SEBI defined fit and proper in 1993 with the 3 crore capital, right? And I argued against Dr. Dave at that point in time, who made that 3 crore. That's wrong because you are preventing professionals from coming in. 3 crores was a lot of money in 1993. And I certainly didn't have 3 crores, so I could not set up an AMC. Sure. And then they changed it to 5 and 10 and then 50. And I fought every single capital raise because SEBI in their rules have equated money with integrity. And I said, no, actually, the more money you have, you should probably question where you got the money from because chances are the money was come in the wrong way. So that's why we've ended up where we are in India with banks, insurance companies as the biggest, largest mutual fund asset management companies and very few independents like Quantum as such in the industry because money has been used as a criteria. On top of the money, they have the rules of SEBI have very intense procedures. There's insider trading laws. Each time we buy or sell our own fund, we have to get compliance approvals for buying that internally. We have trustees reports, we have external auditors, we have a SEBI auditor that comes to audit the fund industry. So there's tons of paperwork that's built. And so I want to know that if all of this has failed, should SEBI be just scrapping all this rubbish and we move to a US system where with $100,000 you can set up a fund? In America, if I want to launch a new fund, I have to put up $100,000 of capital. And in India, I got to put up 50 crores and have all this stuff around me. So if this has failed, why do we have it? Because to me, this regulation in some sense is circular, is an admission of failure. It's saying that, look, everything has failed. I'm not able to protect the investor and supposedly to put the faith of the employee and put them in the same, incentive structure as my client. I'm going to regulate their salary. I've never heard of this anywhere in the world. It is regulatory overreach, in my view. It's like if you have a cockroach or a rat or a mosquito, you're taking a bazooka to kill that cockroach or rat or mosquito. There are other ways, I think, to identify and catch the cockroaches and rats and mosquitoes. The practical aspects of the circular are very dangerous to some extent.
Hmm. Hmm.
It's kind of tantamount to a government telling me what I can cook or not cook in my kitchen, whether beef is good for me or not. It's telling me that out of every 100 rupees of salary that I get, recognize there's a tax, say the tax is 30, I get 70. And I have take home pay as a junior analyst, as a fund manager. I have obligations to my family. I have an EMI on a house. I have so many things. And suddenly you tell me that 20% of that is locked up. And it's locked up into a fund that I manage. And I cannot have diversification of portfolio. So the regulator who is trying to promote and educate the public to have diversified portfolios, across
Yes.
riskless and risky asset classes, is now forcing a section of the public, of the asset management employees, to say, I'm sorry, if you manage the long-term value fund, you are going to remain in the long-term value fund or in something with the equal level of risk. Hey, where's my diversification as an individual? I think this is regulatory overreach. It's not right. I agree with SEBI that there are bad actors in the industry. A bazooka to get them out to kill the ants or the cockroaches or the rats is not the answer, in my view.
Yeah. Well, so okay. I actually agree with you on a lot of counts, but I would still want to ask you a couple of counter questions. One, um, unlike other jobs, I mean, one of the arguments that I've heard is this, right? That why should a fund manager be forced to put in 20% of his salary in the fund that he's managing? The counter is that unlike other jobs, like an IT technician's job, wherein he's not managing other people's money, if a fund manager or a CIO is essentially in the business of managing money and he's got this confidence to be able to go out and tell people that put your money, hard earned money in my hands, and I assure you that I'll try my best to make it grow, why should I not have the confidence to put in not just 20%, but maybe a slightly higher proportion of that into my own fund? Because when I'm asking other people to put in the money, I should be comfortable putting my own money there.
I agree. I'm not saying don't put money. I'm saying 20% and lock it in. If I, as a fund house, don't like equity markets, and go back and read our history, we tell clients move money away from equity, get into gold. We tell them to reallocate the portfolios depending on how we see the opportunities. We don't lock in our client money. These are open-ended funds. In fact, the SEBI circular actually is is attacking active management because
Yes,
it
it is.
excludes people who are managing ETF and indices. Why? Has SEBI got some proof that ETFs and indices are devoid of fraud? We have shown our track record. And the long-term value fund had a terrible 2018 and 19, terrible track record. And that comes in cycles, like I explained. But look at our track record from the inception. We've outperformed the index. So why is it that a fund that has outperformed an index, their employee should have a lock-in, but the index has no lock-in? Or if you're an index fund has no lock-in, is there a bias happening here in SEBI? Is SEBI now becoming a stock picker? Is SEBI saying, look, if you're a fund manager buying index stocks, no salary because it's safe? How can SEBI say that index is safe? What does SEBI know about the index that we don't, or that the public doesn't know, or that the index providers don't know? Why this differentiation? Why is it so? The only way in our business, when you have a venture capital fund, you have a private equity fund, you've locked in your client for 10 or 12 years, or a real estate fund, your client's locked in for 10 or 12 years, and these are HNIs, institutions, and the AIF. There, the institutions ask, can you put 2% of the fund's AUM as the fund manager into the bucket? And you take out the 2% after all of us have got our returns. We give you a performance fee after we've sold every single asset. And if you made a return better than the benchmark, you get a share of performance fees. Those structures make sense, where the client is illiquidity and is locked in. Here we've got daily NAV. Clients can get in, get out of shares. out of mutual funds. Why should there be a lock-in for the manager for 3 years? It's absolutely, it doesn't, it really is not a circular which should have come out of SEBI, in my view. With, again, I fully understand and fully respect and fully recognize the mis-selling that happens in our industry. But at the same time, the question you asked, do you go to a
Is the
doctor?
method.
The doctor looks after your life, forget your money. Do you tell the doctor, please put some deposit into my bank account before you treat me? Come on.
Yeah.
I mean, there are different ways to gauge. We are such a transparent industry. You can look at our track record every single day. I cannot look at a track record of a doctor every single day. I don't
Yeah.
know how many patients a doctor has survived, killed, died. I have no clue. But I know how many fund managers have done well, beaten the index, not done the index. It's for that for people to see. Transparency, transparency, as SEBI has realized with the rules that they come out with, is a wonderful cleansing factor for the industry. Now act on it. We knew what went wrong with the Franklin Templetons. Act on it. Don't put a bazooka on the whole industry. Take away someone's license, suspend them, do what you have to do if you find something wrong. But to take away, hundreds of innocent people, who've got salaries of 50,000 rupees, 80,000 rupees, it's insane. And then this clear
Yeah, it
distinction
is.
and favoritism towards index and ETF. And there was another thing about a few months ago. SEBI came out with another change, and they said, okay, to become a fund manager, you must now put 100 crores on the table for an AMC if you have losses, right? So it used to be you have to have 3 years or 5 years of profits, and you give me 50 crores and I get you a license if you're fit and proper. Now it's like, if you have 100 crores, I don't care whether you made money or not, you can become an AMC. And this is exactly the issue today, that money is available around the world very easily. Does money equate to fit and proper? Is that
Yeah.
SEBI's new yardstick? So
Yeah.
there are a lot of questions to be asked about this sudden swing that SEBI has taken. Again, I recognize why there's anger.
Yeah. Yeah.
I fully endorse SEBI's approach to cleanse the industry, but not this bazooka approach.
Yeah. True.
So
Yeah.
what is your counter to that now?
No, well, so like I said, I mean, I still, you could argue that there's some tweaks here and there, and like I said, the merits and the demerits are out there. If this goes ahead in the current form, there might be a problem at some point of time, as I think somebody was telling me, that if a fund manager were to sell off his units after the lock-in period is done, and then for some reason, if the NAV were to collapse because of an event taking place, there could be charges of insider knowledge
Insider
not
trading,
being
front trading,
shared.
absolutely.
Yeah, and
Yeah,
which
I
may
mean,
actually not be factually true. So there are
yeah.
issues, real issues around the implementation of this, and more so also for the lower earning employees in these tough times or otherwise, to put in 20% of their
Yeah.
take home is a bit tough.
Much of the fund industry is based in Bombay. Housing costs in Bombay are not the cheap; they're the most expensive in India.
Yeah, you're
And
being kind right now.
95% of people who work in the industry were not born in Bombay. They
That's
come
true.
from outside other places. They have no home to live in. There's no government home that they live in. They live in
Yeah.
private homes that they paid EMIs on. And you can't do this overnight. This is absolutely, to me, it's a restriction on your ability to have a
To
job in
attract
this
talent.
country. Yeah, absolutely. And again, if you're a smaller AMC, you will suffer, because you will not get the right talent if you can't afford to pay them more to compensate them for the 20% they have to put in. So the SEBI chairman has gone on record multiple times saying the biggest problem with this industry is that there's high concentration among the top few. This is going to increase the
Increase
concentration,
the
not decrease it.
concentration. Yeah,
Big time.
that's true. Okay. No, I mean, those are some points that I can't even counter, and very valid. So thank you so much for sharing them. Can I wrap up this conversation
Sure.
by asking you, by ending what we started off with? Now, you asked me, do I have an answer to whether the central banks will stop putting in the money, and that will be your, uh, say, indicator of whether value investing will come back or no, right? My answer is that I don't think anybody knows. Between Jerome Powell and Janet Yellen, they are singing different tunes. So who's to say what will happen? Ceteris paribus, or rather, as things stand, would you believe there is a higher probability that because we've had a decade of the markets rewarding growth companies disproportionately, globally and in India, that a mean reversion is around the corner, or maybe that we are already in one. And there's some signs of that, of course. But yeah.
So I don't know about round the corner, but a reversion to the mean or rationality always happens. Bubbles cannot keep on expanding forever. At some point in time, a balloon or a bubble bursts, no matter how much you may try not to make it burst. It will burst. We've seen that multiple times. I've been in this business now since the 1980s, and we've seen so many bubbles come and go. And every time they say, this time it's different. So, Sir John Templeton would say there are five very, very famous words in the field of investment. There are four you hear a lot, the fifth you never hear. This time it's different. And the fifth word is said very silently, sucker, right? So, it will come, there will be a collapse of some sort or the other. And value investing is a very disciplined process. And there are times when discipline doesn't pay and doesn't reward you. Like I mentioned, 2018-19 was a very, very difficult time for the quantum long-term equity value fund. Very difficult time. And we showed our true metal again from 2020, till now. And how long this discipline or fear will last, that we don't know. But I believe, again, this is a very individual thing. I have put more than half of my equity money in Indian mutual funds in the value fund because I believe in value. I'm a value guy. That's my religion. Right or wrong, false in it, that's my religion. But I have bought the ESG fund and I have got the equity fund of funds. And we advise and we tell other individual investors that, look, you are not a value person. So you should not put 50% of your equity in the long-term value fund. Put 10% and put 10 in ESG and put 80 among those other six fund houses that we've chosen for you. And you'll get 80 divided by 6 is 13, 14 rupees. So you'll get your distribution effectively across different funds, right? And that's it. And I really don't think investors in general should worry about the style. What they should recognize is that since 1980, India's economy has grown by 6% per annum in real terms rate of growth of GDP. Stock markets have returned 17, 18% compounded in rupee terms, and they're a wonderful wealth generation engine. And it's likely for the next few decades, India will continue growing at 6% of GDP, and we will continue seeing rates of return of may not be 18%, but 15% rates of return in the stock market. It's really as simple as that. Make the allocation, whether you want to do the ETF and index, if you believe in that, or you want to pick up 6, 7, 8 smart fund managers who are doing index things, who are doing active management to beat an index. That's your choice. But I really believe being in equity is very important for Mr. Young India, whose median age is 29 or 28 and a half, wherever it may stand today.
Well, that's largely our audience as well. So let's hope they are listening in this when they do, nice and fine. But Ajit Dayal, this was a pleasure. Thank you so much. It was lovely talking to you. And I do hope we have more opportunities of being able to talk to you.
I really hope so. I think it took a long time for us to connect. Should not be another 17 years. Thank you very much.
For sure not. Thank you, Ajit.
Thank
And
you so
viewers,
much, Nick. Thank you.
thanks for tuning into this conversation, this episode of BQ Conversation.